velocity doesn't matter. Hey everyone, thank you so much for watching Yankee Stacking. You know, I was just looking through some of my special silver today and getting ready to put a lot of it back into the vault. And I thought I might take some time to talk about something that is a little bit wonky from an economic standpoint. But I really think it's important. There's a lot of talk in the news about inflation, and I've gotten a lot of questions from my viewers and subscribers about velocity, the velocity of money, and how that relates to inflation, and more importantly, how it relates to gold and silver. So if I haven't scared you off at this point, please hit the like button. I think you'll learn something here. So let's just start with the definition of velocity as defined by the Federal Reserve. Oh, my favorite institution. Not. They define velocity as the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given time period. So if the velocity of money is going up, increasing, then more transactions are happening in the economy. You know, the money is going around and around. It's like, you call an Uber and you give them some cash, and then that Uber driver stops and uses the money you gave them to fill his gas tank, and then that goes into the coffers of Big Oil, and they make a purchase for their manufacturing, whatever. It goes around and around. That's the velocity of money. And well, during COVID-19, we saw velocity really take a hit. People stopped buying goods and services in a large way. Many silver and gold stackers have left comments saying that as long as velocity is down, we're not going to see inflation, and it's just not going to happen. And without that, gold and silver ain't going anywhere, Yankee. Now, we have seen inflation going up recently, but velocity is still very low. In fact, incredibly low historically. But I have a real problem with all this importance placed on velocity, at least the way we measure it. Frankly, I think it's largely a garbage statistic, and I'm going to tell you why. But first, let's look at the equation for velocity. So velocity equals the price of stuff, or inflation, that's what P is, times Q, which is real GDP, divided by M, or money supply. So let's break it down. P, price inflation. People, we know that inflation has been systematically undermeasured. The Fed have skewed this number like crazy, and they've done it as a matter of political policy. Everyone in DC knows this. They'll tell you too if you ask them. In fact, every government does this, all right? They undermeasure inflation. Inflation has been mangled with things like substitution, all right, and hedonics, to the point in which the headline number is just garbage. So it's politically manipulated. It's routinely undermeasured, because here's why. If it's overmeasured, then the bond market goes loopy, all right? And frankly, that can't happen, all right? They see the treasury bond market as a matter of national security. That's why they undermeasure P, national security. All right, so let's talk Q next. That's real gross domestic product, or GDP. We really don't have a great feel on how to measure that either, okay? I mean, what do we actually produce anymore? It was a whole lot easier to measure GDP 50 years ago when we had a manufacturing economy. I mean, how many TVs we made, how many bicycles we produced, how many sheds, all kinds of stuff, right? But now you're trying to measure things like the productivity one gets from an iPad, or What's the GDP of all the Excel spreadsheets used in business today? That is a huge guesstimate there. So Q is just another question mark, okay? Let's end with M, the money supply. It's measured in all kinds of ways. M1, M2, M3, which the Fed doesn't track anymore. But those measurements change all the time. Shoot, the broadest measure of money supply was called MZM, or money with zero maturity. That was discontinued at the end of last year, 2020. It covered the supply of all kinds of financial assets, dollars and coins in circulation, checking accounts, saving accounts, traveler's checks, all money market funds. Yeah, it's gone. All right. So it's a very challenging measure to make. In fact, Jeff Snyder of Alhambra Investments talks about how incredibly uncertain this particular factor is in the equation. I'll put a link to his article in the description. It's really good. It's extra wonky if you want to go there, but he really does a good job explaining how the Fed has been trying to adjust and correct factors with money supply for over 50 years. The Fed, he says, has a monetary blind spot with things like the impact of the euro dollar, the massive shadow banking that's going on that incredibly underestimates our money supply. He says, and I quote, "If the shadow money you can't define and measure is so much more and more relevant than the traditional money you can, why bother with either of them?" So basically, we don't know what the real money supply actually is, and whatever. So to say that massive inflation isn't going to happen because velocity is so low is bonkers, in my opinion. We undermeasure P on purpose. We don't really know how to measure Q, and we don't know what M is. So velocity is essentially an exercise in garbage in, garbage out. Now, there's a professor named Richard Werner who's broken down the economy into two things, the real economy and the financial asset economy, what I routinely call the fake economy. You know, that's the thing that we get all excited about when you open your monthly statements. You think you're incredibly rich, right? Because the market's going up. Professor Werner broke down the velocity components of the financial asset economy and said that if you say that the velocity of the real economy is low, then yeah, okay, that makes sense. But the velocity of financial assets, the assets that are the NASDAQ or the S&P or home prices, shoot, Bitcoin, okay? Oh yeah, there's no problem with velocity in any of those things. So the question is, yeah, traditional velocity is low. Asset prices and their velocity is high. So where does it all net out? I don't know. I just think it's, a marginally useful metric today. It's almost like there's too many moving parts for it to be very meaningful at this point. It may be more useful to ask if, trading volumes for the last decade, are those falling? Are those rising? Home prices, are they rising? I mean, if velocity is so low, where's that coming from? At the very least, I think it strongly suggests that there is a split of velocity in how we measure it, and it follows two very different economies. Well, I hope this rather wonky video, let me close this, I'm going to put this away. Oh, there we go. I hope it didn't turn you off. I hope you got something out of it. Please like and subscribe if you haven't. And as always, I hope your day is A-OK.